Okay.
There we go.
Hello, everybody. We are just waiting for some more people to join us. It's not quite 6:30, so this is a bit of a preamble, but welcome to this Noon and AJ Bell session on pensions, particularly on pulling them together and making sure that you've got them all in one place. Yes, well done, Nicola. As always, the Queen Ages are way ahead. Yep, you got there before me. Put all your questions in the chat. Rachel was saying, are we going to have any questions? I was saying, yep, we're going to have lots of questions. They're so keen to put the questions in, Rachel. They're already doing it in the chat before we've even had a chance to tell them. So I think that is a good, definitely a good thing.
Really good.
Yes, I think the questions are not going to be a problem. Here we are. Here's the chat. Yes, please, Nicola and everybody else, put your questions in the chat and we will come to them, as they're there. The idea of this session is to be extremely interactive. So the whole point is that you can all ask your questions. So hello and welcome. I'm sure we've got more to join us. So Amy, from now on, will you let people in the waiting room?
Yes, I'll just let them in as they come in.
Okay, perfect. And we will get started. So hello everybody and welcome to this very special Noon event with AJ Bell about pensions. I'm Eleanor Mills, the founder of Noon, and we're joined today by Rachel Vey, who's the head of public policy for AJ Bell, and also Jackie Natton, give us a wave, Jackie, who many of you will know, who we call General Jackster, who's our MD at Noon and responsible for everything running like clockwork. And what we're going to talk about today is this whole vexed business of pensions. And the more I've come to know about the kind of Noon and Queen Ages, and we all know a bit about the gender pay gap, unfortunately, and many of you like me have hit the troubles of hitting 50 when you get made redundant from the job that you were doing. So we all know that this is a thing. So we know there's a problem with jobs. We know there's a problem with the gender pay gap. What many of us are less aware of is the actually huge problem around the gender pensions gap, which only started being looked at a year ago. It was the first year that the House of Commons had actually started registering the gender pensions gap. And there is a 35% differential between the money that women retire with and the money that men retire with. So the kind of disadvantages that we have during our working lives are then exacerbated when we retire. And when some work by AJ Bell, Money Matters, which I went to the launch of with Helena Morrissey, found that women who got divorced ended up in a really bad position when it came to their pensions. And Helena Morris's big advice there was, if you were getting divorced, not to go for the family house, but to go for the pension money, because most women don't do that. And that was certainly something that I took away from that. So this whole vexed business of pensions is really important. It's hit the headlines a bit because of all the stuff around WASPy women, but it's actually impacting many of us who are younger than that. And I'm someone who's relatively lucky. I worked for the same company for 23 years and I started paying into a pension in my 20s. But even so, when I look at what it's actually going to pay out in terms of a yearly sum, it's not very inspiring. So what we're going to talk about today is, as we say at Noon, you're never too old and it's never too late to do something about it and make it better. And we're going to really take lots of your questions. So, do be prepared to put them in the chat. It's a really rare opportunity to get some really good impartial advice on what you should be doing. And for me, it's incredibly important and a really important plank of feminism that as older women, we really take control of our finances. A man is not a financial plan, as we said in one of our earlier pieces. And I think too many of us, because we're very much caught in this kind of twixt generation between our mums who maybe thought that that was the case and our daughters who know it isn't, many of us kind of felt that somebody might come and save us, but that's not going to happen. So if we're not going to have an impecunious older age, it's really important that we get to grips with this whole pension malarkey now. So that is what we're going to try and do today. I'm going to let Rachel kind of kick off a bit because we're going to talk a bit about especially about amalgamating pensions, because the average Queenager has got 13 pensions in various different places, which is not easy to manage. And then we'll come on and take some of your questions. So welcome, and it's really lovely to see you all. That's certainly enough from me. Rachel, take it away.
Was actually going to say, I think Jackie wanted to do a few words to start off with.
First.
Oh, okay. Sorry. Yeah, sorry, Jackie, go for it.
So just before we get on to Rachel, who is the expert in what to do with your pension, but before you can find out what to do with your pensions, you need to locate them. And I think we're all a bit guilty. Certainly I was, and I addressed this matter about 10 years ago because of things that were happening in my life. I mean, certainly, and I think most of us had this attitude when I was younger, pension was very, very far from my thoughts. I thought, oh, that's something that happens. I mean, I remember resigning from a job in my 20s and them saying to me, what about your pension? I'm like, I'm 27, you know, who cares? But now I care very much. So it's not always been on our minds, but certainly at this stage in life, it should be. And just for those of you, and I apologize if I feel like I'm teaching grandmother to suck eggs, but just to be absolutely clear about what a pension is and how you get one. So first of all, you might have, as Eleanor described, a workplace pension, which is something that your employer and yourself have invested in over the years. Now, because of the nature of female employment, as we know, we often have very squiggly careers. And that is why it's very likely that we might have 13 different pots of money because we worked for an employer, we took some time out, then we went to work for somebody else. So, you know, we end up with all these little bits of pensions and pots of money all over the place. So step one is to try and locate those pensions. The next pension that you might have, and you might have set it up for yourself, particularly if you've become self-employed or a consultant or something like that, is you might have your own private pension, which obviously is something that has been promoted the last 20 years or so, because, you know, the government started to recognize in the last 20 years that the pension requirement of an aging boomer generation was going to be very onerous on the taxpayers coming along behind us. And so they've been encouraging people to have their own private pension. So you might have a workplace pension, a private pension, and then of course there is the state pension, which the majority of us are entitled to, but you're only entitled to your full state pension if you have contributed 35 years of national insurance payments. And again, a lot of people don't realize that. And again, particularly women who've had the squiggly careers, a lot of them find when they go in, and you can go in and check this, that they've only maybe contributed 15 years of national insurance contributions. You know, it's not too late. You can go in and make that up, and we can perhaps come on and discuss that later. So those are the various pots. The state pension, obviously, majority of people are eligible for. The first step before we get on to what to do with your pension is to locate those pensions and bring them together. And that is something that I think a lot of us feel very daunted about. And I know I did it, you know, had a couple of goes at it, didn't know. And then I did get together with a financial advisor, and there is a way to find those pensions, which Rachel will talk to you about. But that is step one. Where is all the money?
So I pick up on that.
Rachel,
that seems like a really good segue into the first question. How do you actually
Where is all the money? Yeah, good
where
question.
is the money? Where is the money? First of all, you will have some pension statements hanging around somewhere. Now, they could be paper-based. I've certainly got a lot of my correspondence with my old pension schemes is paper-based. So you could have paper statements coming in and information like that, or it could be that it's all, you've got some online and you've got some logins and things like that. So the first step is really to find all of these particular pensions. One nice way of doing it is to go through all your different employments. So if you can just map out, really simple task, but just write out everywhere that you've ever worked, and then try and map if you've got a pension and next to it. Now, you're going to have some places you will have got a pension and you would have been either joined the pension scheme voluntarily, or you could have been automatically enrolled into the pension scheme. And that just means that when you start work, you're automatically put into the pension scheme. And then it's up to you to put your hand up and say, actually, do you know what? I don't want to be here. But for most of us, we're quite happy to go along with that idea and say, yeah, we're happy to be in the pension scheme. So you really need to just try and find where these pension schemes are. Now, you could, if you can't remember, and you knew you worked for, you know, Joe Bloggins PLC back in 1999, and you think, well, actually, I can't remember if I actually had a pension from them. You could just get in touch with the company. But sometimes that's easier said than done. You might think, actually, do you know what? There's nothing on this earth going to prevail me to get back in touch with that company. Or you could think, well, I would love to, but it's completely gone to the wall now, and that's just like a distant memory. So if those are the cases, then you can get in touch with the government, and the government has a free pension tracing tool, and you can put in your details and it will find your pension. There is another way to do it, though. There's you can look at using a free pension tracing tool, which be offered by various investment platforms. So AJ Bell offers one, but I'm not here necessarily to plug AJ Bell. You should be thankful to hear. Lots of pension companies do it. So you just get in touch with a pension company and you can use one of their tools, and they will ask you similar questions. They'll say, where did you work, and things like that. And then you can plug that information in, and then they will go and find your pensions for you. So once you've got all that, you know.
So sorry to interrupt. So,
No.
so can they do that just from your kind of national insurance number? I mean, does it matter if you've changed names or you've kind of forgotten even where you might have worked?
You need some sort of, because they're just doing it on the back of trying to find this out with the basic information you've given them. If you get the name of the company slightly wrong, then they're not going to be able to properly trace it. They're probably going off the company, and they will just do that bit for you. They will write to the company for you and say, you know, so if it was Joe Brown you worked at and not Joe Bloggins, then they might struggle to find it.
Okay, so you need some information. It's not enough just to get your national insurance number and get them to go and have a bit of a hunt.
No, they can't do that. They can't write out to every pension scheme. But I'm just going to put in a little tiny bit of information here, Eleanor, because I think this is quite interesting. And there is plans to put in place something called a pension dashboard. And so this is not going to happen for another, where are we, 2021, another couple of years yet. But in a couple of years' time, hopefully there's going to be a mechanism that's exactly what you do. I would put it in and say, my name is Rachel Vey, and this is my maiden name, and this is my date of birth, and this is my national insurance number. And then it will just go out and go ping, 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 around all the pension schemes, and they will all come back and say, yeah, I've got a Rachel Vey on my records, and that will give you the information. But unfortunately, we're not quite there yet. So there is some legwork involved at the moment. So hopefully the dashboard will happen at some time in the future.
You would have thought with all the stuff around AI, they could do, you know, it wouldn't be beyond the wit of them to.
Yeah, no, and they have dashboards in different countries and things like that. It's just that we have a really big pension industry in this country with lots and lots and lots of thousands of different little pension schemes here, there, and it's just difficult to corral all that information together. But they should be able to do it. There's going to be some teething problems with it, obviously, when it kicks off, but you know, that would make life so much easier. But you can do it by yourself and at least get, you know, a long way down this process of just stopping and thinking sometimes about the companies you've worked for. You can start mapping it all out. But once you've figured out where they are, you just need to get some information on them. So you need to know how much they're worth, what type of pensioner they are, because there are different types of pension and there's different ways that pension savings build up. To use and I'm going to start getting into jargon here, and I do apologize for this, but things called defined benefit or defined contribution schemes. And so there's different ways these things build up. And so once you've got all that and you've got a little bit of information about how much they're worth and where they are, then you can look at, say, how much are they charging you for this, and what could you move it if you want to? And then you start to think about, well, do I want to move them all together? And you just need to really work that one through. But there's lots of advantages for putting all your pensions in one place, because instead of having 13 different pension pots to sort of like figure out how much have I got in that one and how much have I got in that one, you've just got one overall pot to look after. And that means also that it's all in one place. It's fewer statements, fewer login details. It might mean that you move it from somewhere that's quite expensive to somewhere that is cheaper. It could mean that you get a lot more options about how you want to take your money at the end of the day, and also options about where you want to invest your money as well. So there's lots of advantages for putting them all together. But there are also some things to watch out for, and you've just got to be really careful when you look at pensions, because they could have penalties on them, for example. So you don't want to move a pension that has got a penalty on it necessarily. Or it might have some sort of special deals on it, some sort of special terms or special features. Or it could be that it's what's called a really gold-plated pension scheme, a defined benefit scheme, and you can't really easily move one of those as well. So there's lots to think about within this whole idea of bringing all your pensions together, but certainly the first step has to be, and that's what gives you control, is actually just knowing how much money you've got and where you're going from there. That was a very long answer, wasn't it, to a question? And we've lost Eleanor.
Just out of interest, Rachel, the retirement age is currently 66, isn't it?
Yeah, the state pension age is 66
Right.
at the
How does
moment.
that relate to these other pensions? So, you know, we find all these pensions. Do you start taking them at 66, or is there a time, is there an age thing around that at all?
Yeah, well, at the moment, the deal is that you can start accessing them, as we call it, start taking the money from these pension schemes from age 55. And again, it really depends upon what type of pension scheme you're talking about. If you're talking about a defined contribution scheme, which is one where I put some money into a pension pot and then it gets invested and it grows alongside investments like equities and stocks and shares and things like that, then you can get hold of that money from 55 onwards. If it's something called a defined benefit scheme, then it's what that one does is to promise to pay you out a certain income that's based on how many years you've worked there and how many years you've been building up the pension scheme, plus your salary. So it works out an income it will pay you. And often with those pension schemes, if you take them before what's called the normal retirement date or the normal retirement age, then they might put a penalty in. And they might say, well, actually, if you're going to take it a little bit earlier than 65 or 60 or 66, then we will apply a little bit of a penalty just to bring you down. So it really depends upon what type it is, but most pension schemes you should be able to access from 55. But there's a couple of issues around that. The first one is that, as you said, the state pension age is 66 at the moment, but it's increasing to 67 in 2028. So when the state pension age goes up to 67, the age at which you can first take money out of your private pension is also going to go up to 57, and it's going to go up at that time. So that's worth bearing in mind. And then the second issue around this is that pension schemes are there to give you an income really for your later life. And there's lots of issues around the gender pensions gap. And partly it is because of what Eleanor was saying earlier, is about how we don't save enough. We have squiggly careers. I love that. We have squiggly careers, and we maybe don't earn as much as men. We've not saved as much as men because often our salaries are being used to fund the kids' school shoes and things like that, rather than prioritise for saving. But the other thing is that we as women are really fortunate in a way, but we live longer, but we also need money to last a bit longer as well. So I would probably just add that in. When you 55 sounds great, doesn't it? I'm not far off 55, so I think, oh wow, I could get hold of my pension money. But I know also that you've got to think about how long you're going to live for and how long you need an income for as well.
And I think also, just on the point about divorce, which Eleanor alluded to previously, you know, I think probably a lot of women, you know, and nobody thinks they're going to get divorced. And if you've got a partner who's got a very good job, and, you know, with a very good job comes a very good pension, you've probably spent 20 years of your life thinking you're safe and secure, and it comes out of the blue, obviously, when that marriage ends. And you know, it's doubly troubling, because that big pension sits with the husband usually, and that's something you then have to fight for. And so, you know, something you probably don't know much about, and it all becomes a big issue, and it's very complicated. So I think for anybody who is being divorced or getting in the middle of divorced, or thinks there might be a divorce on the horizon, it is a massive issue, I think, around divorce, because it really will, you know, be the indicator of how well you can live for the remainder of your life.
Yeah, and it was one of the things that I was most struck by. Of somebody who missed the beginning of the meeting, I was talking about the Big Money Matters launch that we did with Baroness Helena Morrissey, who was the AJ Bell chair and now heads up their Money Matters, and she was talking about how during divorce, it's one of the big mistakes that women make, that they go for the house, and of course the house takes a lot of upkeep, and you know, and they don't go for the pension. And her number one advice was make sure that you get a chunk of the pension if you're splitting up, and that most women don't. And you had, so I don't know if you remember the actual figures, Rachel, but I remember being really horrified by the differential amongst couples after divorce, that the man would come out with like 250,000 and the women had like 50. I mean, it was really shocking.
Because what
Yeah,
women don't
I would-
realise is they have the family home perhaps, but then they're going to have to end up selling it to release equity
Yeah.
to live from.
Yeah.
So you know, and it's just a sort of not thinking. I mean, obviously it's a terribly stressful time, and maybe sometimes you don't get the right advice, etc., etc. So it's a really, really big one, I think, the divorce around pensions.
Yeah.
I really agree with that. And just one other thing I would add on to that, I work a lot with financial advisors, and I know from talking to them that often divorce lawyers, you know, they're great at their job. They know exactly what they're doing when it comes to looking at how you split assets on that basis. But they might not understand pensions, because they can get quite techy and quite difficult and quite, as we all know. So it's always worth just making sure that the lawyer that you're working with is doing that. It's almost like maybe just applying a little bit of pressure to them to make sure that they're actually really taking into consideration the pension as well, because there's far too few pension divorces happen where, you know, far too many divorces still happen where people aren't taking account of the pension. So
yeah, so just if you come away from this webinar with one useful piece of advice, it's the thing that I kind of say to everybody, because I didn't know. And then the other piece of advice I took away from that from Helena was, she said that every time a man asked her for a pay rise or for a kind of salary increase, they would, like 9 times out of 10, ask for an increase in the pension contributions that the company was making, as well as part of that negotiation. And she said that she could count on one hand the number of women who'd asked about their pension in the whole time she'd been working. So that's another thing. I had no idea about that, but I think that that's also a good piece of advice. You know, for ask if you're getting a pay rise, also ask about what's happening to your pension, and just be really aware of some of the kind of good tax implications of putting money into your pension rather than.
Oh, hello, she's gone again.
yes.
I was just going to say, Rachel, which perhaps we should have said, and there's a couple of questions in here saying, what should I do with this? What should I do with that? Obviously, we, and specifically Rachel, although she works for AJ Bell, cannot give financial advice. So, you know, that has to be regulated and all the rest of it. So we just want to caveat whatever's said on here is going to be based on stories and experience, and maybe giving you examples of the sorts of things you can do, but we won't be actually saying you should do this or you should, because there's a couple of questions in here that are quite specific, and obviously we can't answer those specific questions, tell you what to do, because that is financial advice which has to be regulated. So but that's the purpose of this webinar, is so that you can have a good think about, you know, raise some questions and issues for yourself, and then go and find someone, specifically AJ Bell in this instance, who can then help you through the minefield of this whole issue.
Should we tackle maybe some of the questions, or?
Well, I've got some questions. I've got quite a few questions here. There's a few questions here. So there's the first question, and it sort of prompted me to say this, is from Liz, who, you're a widow, Liz. I'm a widow also. I understand how that is. I was self-employed. You just got one private pension. It's very small, but you're just going to inherit a house, and you're wondering how you should manage that asset in terms of when it's, sold, what you should do with those assets. And should you put it all in your pension? The second question is, can my kids inherit my pension? I think the answer to the second question is easy, isn't it, Rachel? They can inherit your pension, can't they?
Yes. So it depends what type of pension it is again. So it's never easy with pensions. I will say that every single time. But if we're looking at a what's called a money purchase or a defined contribution pension, like a SIP, which stands for self-invested personal pension, then when you die, because unfortunately we all die, when you die, you can to complete something called a nomination form or an expression of wish form. And this is the other thing I would really like you to take away from this one. Could you please just make sure that you always fill that in?
Yeah.
It's for tax reasons, and I can get into the tax reasons later on if we really feel that way inclined, but hopefully we can avoid that. But it's really important to make sure that you say exactly who you would like to inherit the money, because that just gives them so many options. So for example, I'm married and I have 2 children at the moment who are under 18, but let's whatever, and they're older than 23, so let's say they're 25 and 27 when I die. Then my money, I will be living with my husband hopefully by that point, but don't rely on the man, so you never know. But let's say that happens, my money would probably go to him as a dependent, but I could fill in a form saying I really want my money to go to my children. And in that case, then that gives them the option that they can take the money as a lump sum, or they can just keep it as a pension pot. And that means that they can take the money out gradually whenever they need it. And it just means it might work for tax efficiency, depending on what age I am when I die. But it just means they have more options and more flexibility. So it's really important, and especially when you're looking at someone like Liz, who is maybe hasn't got a partner, or you're not living with somebody, then it's really important then to say who you would like to inherit your pension money.
I am widowed, and I have 2 grown-up children who are 30 and 27, and they're both on I have a SIP, and they both inherit my SIP, if I pass, and I think it'll be tax-free. So it's very important to do that. And actually, Liz, as you're in a position where you only have a very small pension and you're thinking about doing something, you can take that into account, can't she, Rachel, when she goes and looks at so you can choose, you can then that can go into your decision process of what would happen if anything happened to you with that pension in your circumstances.
Yeah, absolutely. What I would do is just pick you up on one point. It's not necessarily tax-free. It's not going to fall. Pensions are bizarre things, bizarre creatures, because they're under a mechanism called a trust, which means that they don't fall into your estate. So if I have £100,000 in my pension, that won't fall into my estate when they're looking at inheritance tax. So they're usually free from an inheritance tax, but they're not necessarily tax-free. At the moment, the rules are they will be if you die under the age of 75. But if you're over 75, then when your children get your pension, it will be taxed to whatever rate of income they earn. It'll just be counted as earned income. So it's really bizarre, the rules. It's a real cut fine cliff edge of age 75, and it just depends then. But it's important to know what the tax are. But it's still, regardless of how it's taxed, it's still a really valuable thing to make sure you pass to the right person.
So would you say that we should prioritize putting money into the pension over putting money into kind of ISAs or that kind of thing?
I think it's a really difficult thing to say. What my starting point with all of this is usually, Eleanor, what I usually say is, in a way, I don't care where you save. I just want you to save. I just want you to save for your future, because we always get loads of questions like, should I buy a property? Property is the way forward, or should I put it into an ISA? And I really don't mind which way you do it, as long as you save for your future. There are benefits to saving within an ISA and benefits to saving within a pension. They both get really good tax advantages and tax breaks. The thing to say about pensions is usually you are going to be saving into one if you're working, because you're automatically enrolled into a pension scheme. Most people are automatically enrolled into a pension scheme when they first join their employer. And as we were saying, these things are really valuable. This is part of your remuneration. This is part of your salary. You would never go and join a new employer without knowing how many days holiday you get. So this is just as important. You need to know how much that employer is putting in. So it's really important part of your wages and your remuneration. So if your employer is offering to put money into your pension scheme, then you say, yeah, that's fine, because they will probably only offer to do it if you contribute as well. So yeah, you stick with that, because that sounds really good. If you're looking at money above that and you've got any spare income, then you can look at ISAs, because the good thing with ISAs is there's no tax to pay on it when you take the money out. So it's really tax advantageous there, and it's really simple and easy, straightforward. If any of you are under the age of 40 or have something called a lifetime ISA as well, you may be able to get a bonus from the from the government. The money you put into a lifetime ISA. That's only for a lifetime ISA, and it only it's really age dependent.
Yeah, we're probably all a bit old for that, aren't we? So this point,
depends.
That boat has sailed. Yeah,
it depends, and it might be useful for your kids.
Yeah, so at this point, if you've got some kind of, you have a bit of extra money, you know, my book's about to come out, so I'll get a bit of money for that. Is that the kind of thing that I should be putting into my pension, or is that something I should put into an ISA?
As I said, it really depends. ISAs are easily accessible. There's no tax on the money you take out, but you do pay it from your taxed income. So you get your royalties or whatever, and it will be taxed, and then you can put the money into an ISA.
Okay.
With a pension, what happens is you get something called tax relief, and it can be really complicated.
Yeah.
I mean that the contributions go into your pension before it is taxed, before your income is taxed, or it could mean that the government puts in an additional contribution into your pension. And this again is a 25% bonus. So they add in another 25% bonus. So even though you get taxed on your income and you say, well, I've got my taxed income here, I've already paid tax on it, I'm going to put £100 in, then the government would add in another or you put in £80, then the government would put in £20, and it will get up to £100. So it's a really big tax advantage from doing that.
Can I just ask Rachel as well on that, on the tax thing, is that if you're a 40% taxpayer, wasn't there?
Yeah, you get extra money if you're a 40% taxpayer.
If you are a 40% taxpayer, I happen to think it's a little bit scandalous, but anyway, if you're 40% taxpayer, you will get that added up at 40%.
Well, it doesn't go.
So the government is topping up your pension for you. Thank you very much.
It doesn't go directly into your pension scheme, but you will get an adjustment to your tax.
Yeah.
So you will get the money back, and it will cost you less money to put it in.
So it can be quite tax efficient to put money into your pension rather than into an ISA.
Yes, it can. But the problem is you can't get hold of it until you're 55 or 57. It could be, yeah, so there might be issues around that. And when you take the money out, you get 25% of the money that you take out, you can get as a tax-free lump sum. So again, that's really tax efficient. So for all those reasons, pensions are really worth looking at. They may be not as accessible as ISAs. There's no age limit on when you can get hold of the money, and it just depends. But I would, yeah, definitely, as I said at the beginning, in a way, I just want you all to save.
Okay, that's really
I've got some other questions.
Yeah, we've got some other questions on the thing. So
I've got another question here.
I want to do Nicola's question, because
yes, exactly. That's what I'm just looking at.
Brilliant.
Yeah.
Go on, you go, Jackie.
So you're saying, because Nicola's got a question, and another C. Lockwood, sorry, I don't know your name, as a similar question. And she mentions part of my workplace pension has a GMP element. I'm afraid I don't know what that is in it, and I'm struggling to transfer it into my private pension. I've been told by a financial advisor that this is not always permitted or costs a lot of money to transfer. He says changes are afoot. What are they, and what can be done in this situation?
And what is a GMP element? For those of us who are real ignoramuses on this.
No, you wouldn't. No one should know what a GMP element is. You're okay. A GMP is a guaranteed minimum pension.
Okay.
So the state pension has changed lots of times since, I don't know, since about 1956 or something like that. It has been different changes to it. Every time we get a new government or a new couple of governments, they all before 2016, maybe from about 78 to about 97, something like that, maybe a bit later, that you could contract out of the state pension.
That's
Now, out of so it's out of the additional state pension. So you had your basic state pension, and then you had a little bit extra on top, which is called the additional bit, and that was related to how much you earned. But you could contract out of that, and what that meant was that instead of paying the national insurance rates at the higher rates, you paid the lower rate of national insurance. But what you did was you saved that money within a private pension scheme. Now, often the pension scheme was contracted out, to use this words, and that meant that the pension scheme, because you were part of the pension scheme and you might not have made a decision to join the pension scheme, you were contracted out as well. So it was one of those sort of things that really just happened to a lot of people. There were some pension schemes which, when you contracted out of them, they paid a guaranteed minimum pension. So they said, right, well, we guarantee that you're always going to get £500 a month, and you might have got more than that, but we're going to guarantee that you're going to get that £500 a month. Now, that is a really valuable benefit. The minute we start using words like guaranteed or promised or anything like that, we're going, oh, that's quite nice, that's good, that's lovely. And that's why defined benefit schemes are really good, because they promise to pay you out a certain amount of money. So a guaranteed minimum pension is a good thing to have in a way. But because it is so valuable, the government and the Financial Services Regulator, the FCA, was really worried that people would start transferring their money from one of these really good pension schemes into somewhere else and don't realise what they're giving up. So they said, right, well, okay, if you are going to transfer, if you've got these really good type of pensions where there's a guarantee or there's a promise involved, then we're going to call these things safeguarded benefits. Don't you just love the word jargon? It's lovely, isn't it? Anyway, safeguarded benefits. And we're really worried that people are just going to transfer these things willy-nilly. So what we say is that if you've got enough safeguarded benefits and it's worth over £30,000, then you have to get a financial advisor's personal recommendation to transfer. And the trustees of the pension scheme you're transferring out of have to sort of say, well, have you got this? Have you got this financial advisor as recommendation before you transfer? So it means that to get that, if you've only got 31 or 32 or 35,000, you haven't got much GMP in there, then it could be you're going to have to pay to a financial advisor a sum of money to look at your pension scheme and to say whether you should transfer or not. Now, the financial advisor is probably going to look at most of them and say, I don't think you should transfer because these benefits are so valuable. I don't think you should transfer. And it could be that you can just say, well, I don't know, forget it then. I'm ignoring you. I'm just going to transfer anyway. But most of the time, it just makes it really complicated for you to try and get your money out of that pension scheme and put it somewhere else. So I really appreciate where Nicola's coming from. I think it can be incredibly frustrating, especially if you don't really, value what you've got. But unfortunately, those are the rules. I'm a little bit confused.
Would you not say though, Rachel, that it's actually, if you've got a safeguarded pension like that, you should keep it? Because I am a victim of a financial advisor who took my safeguarded pension out and lost it all. So I would say to anybody from personal experience, if I'd have known then what I've known now, I would not have transferred it. And
it depends on personal circumstances. And I think it really depends upon what the safeguarded benefit is. But you're right, these rules are put in there for a really good reason. And that's to protect us. So I'm just saying I can appreciate from Nicola's point of view that it could be really frustrating because you're thinking, well, actually, I just want to get my money from one place to another. But maybe it's about understanding what you've actually got.
So do you think Nicola should just dig a little bit further down and see and really understand what that GMP is, the safeguarded benefit, so she can make a more
Yeah, so
informed decision?
Nicholas, she's just put on the chat, she says hers is a tiny part of the pension and it offers a very low annuity. So it might make more financial sense for her to move it out. But
Yes, it might, yeah.
But I think she needs just maybe get a little bit more information and find out how much the safeguarded benefit, the GMP, is actually worth, and whether it's under or above this magical 30,000. Because if it's under 30,000, the trustees don't need to see that you've had regulated financial advice. So you can maybe go back on that basis. Unfortunately, Nicola, I don't think this is changing. I'm not entirely sure what the financial advisor was referring to. And sometimes, it's like these things, it's Chinese whispers. You just don't really know sometimes what they're referring to. But I don't see this actually changing very soon. It's not something which is really under consideration. If anything, I just think the 30,000 would probably just go a little bit lower or something.
Mm.
And C. Lockwood is saying some people have built up substantial defined contribution pension pots. What happens in the investment holding company that pension pot goes bust?
You would have built up a defined, if you're in a defined contribution plan, if it's FCA regulated and it's part and parcel of that, then you get £85,000 of it is always protected. And we all get this FSCS, it's called protection. If it's within an occupational pension scheme, which is something which isn't looking at which isn't come under the FCA, then it could be that you're going to get a smaller proportion of the money back. And it just really depends upon how the pension scheme is wound up. I think for that, I'm unable to probably tell you exactly what you would get, but it's probably worth going back to the trustees of the pension scheme or to the provider. If it is FCA regulated, go and look at the FSCS website, the Financial Services Compensation Scheme, and that will tell you how much money you can get back and how that works in those particular circumstances.
Yes, I mean, yeah. So sorry, C. Lockwood, I don't know your first name.
Catherine, I think, isn't it?
Is it?
Yes, she's saying, hi, Catherine, nice to see you.
Catherine, sorry. Because the specific question is what happened if the investment company holding that pension pot goes bust, which is different to it. Because I know, so my employer was Arcadia, which went bust, and those pensions then go into what they call the government lifeboat, don't they? But if it's the
that's for the that's called the Pension Protection Fund, and that's if a pension scheme winds up.
Yeah.
And there's no money behind it.
I mean, can an investment company go bust that's holding your pot?
Yeah, it can, but again, it will be usually it's worth going on to the Financial Services Compensation Scheme, and that will go through exactly what compensation that you are due back. And it depends who regulates the investment company. So if it's a UK regulated investment company, then you've got that £85,000, which I appreciate might not be the whole value of the pension pot, but it's something. If it's regulated by an overseas regulator, so if the investment company is not regulated here, then it's a different question. And then that just depends upon where it's regulated and what the rules are for where the country in which it's regulated. So it's difficult to give like individual steer, but I would start by looking at exactly where it's regulated and what sort of company it is, and go and talk to the FSCS, because they can be really helpful in these circumstances.
Thanks, Rachel. That's great. Now, I really like this question from Jo. She says, thanks, Rachel. She says, any advice on how best to calculate how much we'll need in retirement? There are so many different calculators and very varied answers. What's the amount that we will need to have saved? I think that's a really great question.
It's a really good question, Jo, because it's something that I think everyone struggles with. And I really wish I had a magic formula for you. I really wish I could just say it's the A plus B times C equals D squared or something like that. It'd be lovely. And it's not, it's really down to your personal circumstances. Again, it's really just down to how you work and how you envisage your retirement. So you could just say, And in the olden days, they used to say, oh, you know, you're going to get like 2/3. You need 2/3 of your current income in retirement. And that's the amount of money you need. But nowadays, I think it's a little bit more difficult than that. And you might want to just drill down and actually just look at this line by line about what you think you're going to need. So there could be something like some of the expenses that you have at the moment may just, you know, die away. So for example, as I said, I've got 2 kids under the age of 18, and you know my food bill is according to them. So obviously, I'm not going to need that much money. I might not to spend on groceries. I might not when I've retired, I might not commute as much. So again, I could cut down there. I could be something like a term assurance plan might be linked in. I could be to my mortgage, and therefore that would disappear. Maybe my mortgage would disappear as well, and I wouldn't need that particular one. Or if I'm putting kids through university or something like that, and if you're doing that, then you wouldn't have that expense. So it's maybe worth just taking some time and thinking about, actually, what do I need and what are my expenses going to be? Now, I think this is really quite difficult to do. I mean, it's one thing, isn't it, to have a monthly budget, which always sounds really frightening to do, but to actually start thinking about how that works in retirement, it's like, you know, it's doubling down on that. But there are a couple of places that you may want to just go and have a look at. The first one's called the Pensions and Lifetime Saving Association. So that's PLSA, and they put together some retirement standards. The other one is which I'm sure you've all heard of, which the consumer organization, and that again has looked at how much money will people need in retirement. Now, this is really individual. As I said, it just depends what you want to spend your money on. But I've got some figures here from which, got some figures here from which I'll just run through really quickly for you. So if you have, they put it into 3 categories. You've got essential, comfortable, and luxury. So essential is just covering the absolute bare minimum, just what you need to get by. And it does include things like housing, but it does include some essentials. And they reckon that you're going to need £13,000 a year if you're a single person, and £19,000 if there's 2 of you living in a household.
And what's the state pension worth in relation to that?
Well, state pension's worth £11,500.
Wow, so not even enough to kind of keep you in essential.
No.
Right, that's scary.
No, it hasn't. But if you have no other savings, you can get a little bit extra onto your state pension. But yeah, the basic thing is you're going to need to have some extra savings there to just boost it up. If you're looking at a comfortable lifestyle, that's £20,000, and that's a few more, some short haul holidays, a little bit more gifts to the family. And I was very interested to read that also includes alcohol. So apparently alcohol isn't an essential, but you know,
that's good.
Luxury. Yeah, luxury is the
gin.
next one up, and that is, yeah, luxury is £32,000 a year if you're just single, and £44,000 if you're a couple, and that includes long haul holidays and a few house improvements, a few other bits and pieces, a new car every 5 years, all of that sort of stuff. So this gives you sort of like a rough idea. It's a good starting place to think, well, that's the sort of income I'm really aiming at. But it's one thing to say, well, that's what I want, and that's the income. Then you've got to sort of like convert that into a pension pot and how much you need to save within a pension pot to get you there. Now, some of these things will be income because you will have a state pension, which provides you with an income, as you said, roughly about £11,500. And a defined benefit scheme will give you an income as well. So if you're lucky enough to be in one of those things, that will give you an income. But some of them work as I said before, as a defined contribution or a money purchase, which means you just get a big pot of money at the end of the day, and then you buy an income from it. So they reckon that if you're looking at that comfortable level, if you are looking at a single person, you're going to need something like £115,000 pension pot on top of your state pension to get you that income of £20,000 just as a single person. So that gives you an idea. Now,
So hang on. So just to clarify, so if you have, so you get the state pension, which would give you 11 grand. What? And then you need savings of 115 to get you up to about 20,000
Yeah.
as a kind of annuity or an added bonus. So if you're
Well,
looking at
that's
what
as a drawdown. So there's it again, it
Drawdown.
gets really complicated about how you actually get this income. But
Right.
that's drawdown. But if you were to buy an annuity, which is a guaranteed, absolutely no one can squeeze out of that, you definitely absolutely get that money, you would need 130,000. So slightly more.
just to get another like 9 or 10,000.
And
Yeah.
the annuity depends on the interest rate environment at the time.
Yeah.
So last year, annuities, they've gone out of fashion for many, many years because of low interest rates. But last year, people were buying into annuities because their interest rate was 5%, and it suddenly became a better deal. So
Yeah.
that's another, so there's a little bit of another story, but that used to be the old-fashioned way of getting your pension, by buying an annuity that threw off your income for you, which was guaranteed a set amount.
Oh, okay. So the drawdown, Rachel, sorry, forgive me if I'm really ignorant.
No.
So drawdown on this is
Never
you're
ignorant on
taking-
pensions.
You're literally taking kind of a chunk out of that pension pot, are you, every year?
Yeah, that's basically what you're doing. Is there's two
Okay,
different
but
ways.
I've never
It's
understood
either-
the difference. So that's really helpful.
No, it's a really good question, because as I've said, there's so much jargon, and I should have said this right at the very beginning, Eleanor. There is never a daft question when it comes to this. It really isn't. Nothing is daft or stupid or anything like that. Every question is valuable, because
Okay,
there's
so-
someone out there not knowing.
So annuity, you buy something which basically guarantees you a certain amount of money a year.
Think of
And on
it
the-
think of it in either DIY
Yeah.
or you get someone to do it for you. So if
Okay.
you buy an annuity, what I do is I turn up to a company, an insurance company with a big pot of money, and say, you give me an income every year, and
And
they
you
will
can
give
have
me an
this
income.
money.
Yeah.
You have this money and you give me this. And they go, right, okay, I will manage your money alongside everyone else's money.
Yeah.
And I will put it all in one massive, great big pot. I will do all of that. And I guarantee, it's really important, this word, guarantee
Guarantee.
that I will pay you that income. If it's drawdown, then it's a DIY thing. So I am saying I will put my money into a pension fund. It will keep invested, and I can take the money out.
And are
And
you
I can
taking
take
the
the money-
interest off the money, or you're actually taking the capital out to live on?
You are, that's a very big question. But you're
Yeah.
taking a income out of that money. That money will grow each year, and there will be a return on it, and the return will go back into the pension pot. And you can do it so you live off what's called a natural yield. So you just live off the money that you get back in returns, or you can take a little bit of the capital as well.
Right.
And most people just take a little bit of that. But you are taking on the risk then of making sure that you can carry on having that income for the rest of your life. But what it also
Yeah, and if you
means
think
is
that
that
now women live longer, I mean, we called noon because in the 100-year life, 50 is only half through. So if we're talking about retiring at kind of 68, and then maybe you could have another like 30 years of life which you're going to have to fund, and your kind of nursing bills maybe at the end. What's the realistic amount of money you need to have a comfortable, kind of last kind of third, as it were?
Well, I think that's what Which is trying to find out. Just on the drawdown, can I just add just one other bit? It means that you do on a DIY basis almost. You figure out how much money you want to take out. But what it does mean is that you're put in the driving seat. So to start off with, you might not be fully retired. You might do a part-time job, or you don't know, you might just ease into retirement. You might
We're all
want
going to
to
be working
live-
till we die, aren't we, Rachel? That's basically what you're saying.
Some people might want to.
Yeah.
Or you could be living the life of Riley and want more money than the pension scheme than an
Sure.
annuity would offer you. But then you know that you're going to be living much quieter life, and you can go down on how much money you need. So what a drawdown does is puts you in the controlling seat, in the driving seat, and you can figure out how much income you need for your personal circumstances.
Yeah.
But with all of this, so Which have said, this is how much income you might possibly need, depending on what lifestyle you want.
Yeah.
This is the pot of money you need to get there. So what you could then do is take this information, going right back to, it was Joe's question, wasn't it? Right back to Joe's question, is then what you can do is to go onto go onto Money Helper is probably a really good place to start. Money Helper is a guidance website from the government. And if you go onto Money Helper, then you plug in the information about what sort of income you want, what you've got at the moment, what pension pots you've built up already. When do you think you're going to take the money out? And it will work out that bit in between where you sat there going, well, I've got this bit of information here and I've got that bit of information there. How much more do I need to start saving now to get me to that place? It will tell you those answers.
I've just put that in the chat, everybody. It's called Money Helper. So it sounds like the government's trying to kind of help us a bit. Now, I'm just aware that we're kind of getting towards the kind of end of our hour. So I just wonder if there's anyone out there who's got something burning that they want to ask. Here we go. Unknown pension question. Have been paying into a private pension for years, but have lost all login account info. That sounds very like me, Kate. But they take a direct debit from me every month. How do I find my account number and access it? I totally know it sounds insane, but it's very hard to find information on your own pension. Any thoughts appreciated? Kate, I had something really similar. I had a kind of insurance thing, a life insurance thing I've been paying for ages, and I had no idea what it was or what its benefits were. It took me ages to unravel it. So you're not alone on that.
You're definitely not alone, Kate, because I'm in a similar position as well. I've been trying to track down one of my pensions as well, and it's been an absolute nightmare. So don't get married is always my advice, because it seems to completely confuse people. Yeah, I think with that one, if you know what the company is and you know which company is taking your money from you as a direct debit, then you just get in touch with that company. I think it's just a case of you have to phone them up. I wouldn't do this online or email or anything like that. I would use the really old-fashioned tactics of getting on the phone. If they are taking money from you every month, then they have a responsibility to get, you know, to get back and to let you know, even if you don't have an account number, you giving them that your national insurance and your date of birth and your name currently, and if you have changed your name, your previous name, then you should be able to track it. I don't want you to necessarily, Kate, name and shame people within this sort of like open forum, but please, if you want to get in touch with me afterwards, then please get in touch with me. And if it is one of the household names and things like that, I'll see what I can do to help you track it down.
Yeah, that's a really nice offer. Kate, if you email us, we'll put you in touch with Rachel to sort that out for you.
Can I just make another quick well,
yeah, just to say, and what I did on that, I was paying Aviva or something for this insurance thing that I was doing, and I rang them up, and they were really, really unbelievably unhelpful, actually. And they said that because I didn't have any kind of, you know, details, they wouldn't help me. I had to get quite cross with them, and finally kind of went through to, you know, I just kept saying, no, this won't do, you've got to keep, you know, and escalating the problem, and then they finally did help me. So I would definitely take up Rachel's thing, because it's now so impossible to get through so many of these digital portals, and when you do ring up, they say, oh, well, you need your code or you need your account number, you can't actually get through to anyone. So I would definitely take Rachel up on her offer of help.
One thing I was just going to say on that, as somebody who's moved around a lot, we always forget to change the addresses of these pension places. I've just had a letter last week to say, we think you've moved, and it's been forwarded from somewhere else, and you think, oh my God, I've done all my change of addresses. And a lot of people lose it because they change address. So always make sure when you move that you let your pension companies know, and you know, you might not have any documentation because literally you've moved twice or something, and that's why you haven't got any of your documents. And if you go into your where the money's being taken, hopefully there's a reference in there by your direct debit that will give you the information you need to talk to somebody at the insurance company. Because I've done the same thing.
There isn't always, though. There wasn't for me, and they treated me like I was a complete idiot. And I was actually.
I've had lots of runs with Aviva. They can be quite difficult, but you have to get there in the end.
I got there in the end.
And the other thing I would say, ladies, please note that if you're single, it's much more expensive going into retirement. If you notice from the numbers, you know, so a single person needs 30, you know, just a married person needs 44. So, you know, we have to watch out for that. Again, back to the divorce and the being widowed or whatever. You know, if you're single, you just need, it's just much cheaper to be a couple. So that, you know, it's one of those things.
Yeah, and it's worth saying 40% of our Queen Ages are on their own. So, you know, if that is you, you're not alone. Yeah, the single penalty is real. You're totally right, Joe. And it's really, you know, it makes it even more important, all the stuff that we're trying to do at Noon, also about keeping women in their 50s employed, because you know, if we get whacked and we find it hard to get jobs again in our 50s, then that's 18 years when we could be paying into our pension pots, which we're going to need because we're going to live longer if we're lucky, where we're not doing it. And that is one of the things that the government are really beginning to take notice of. We're going to do a Noon event at the Labour Party conference with Annalise Dodds, who's the new Equalities Minister, and Rachel Reeves and people, to really kind of make a fuss about the fact that what's happening to Queen Ages in the workplace, because it's all these things that are linked together. And we have to kind of really keep pushing on this. I think this has been a fascinating session. I've learned loads. Like Rachel, thank you so much. They're clapping. They're clapping out there.
Oh, thank you,
Caroline. Big cheers for Nicola. And we're going to do this again. We're doing this again in August. We're going to be talking about risk and what is our attitude to risk and what does that mean in terms of finances. And we're also going to put this on our Noon YouTube, and it will be on the site. So in the money bit of the noon.org.uk website, so you can see it again if there's things that you missed or you want to direct people towards it. And also do check out the AJ Bell Money Matters newsletter, which is done by Rachel and her team, which is brilliant. There you go. Amy's just put it up there. And also the link to the Understanding Your Pensions piece, which we've done with them, which is on the Noon website. So we'll be telling you about the risk webinar, but we're going to do another one like this. I think it's with Danny Hewson next time, not Rachel. But we're really here to help. If you send us your questions as well, if there's anything else or anything you want to follow up on,
send your questions,
we'll pass that on to Rachel. And risk, I think, and what risk means. I had something from a financial advisor this morning saying, did I want to move into this account, this investment? And I had no idea. I had no way of calculating whether that was a good idea or not.
What's
so
your attitude to risk? Are you, medium, low, high, cautious, whatever? And it's very important, because I think when I was younger, I was very, very open to risk, and now not so much. So, that's on the 20th of August, and it's available. If you want to sign up, you can sign up now. And then on October, I think it's October the 7th or 8th, we've actually got an in-person event in London, in central London, which is going to be a big event. It's going to be quite fun. Which is going to be hosted by AJ Bell, and if you want to come along to that event, we'll be, that you can register for that.
It's going to be hosted by us.
Hosted by us.
It'll be a Noon event. I'll be there. Jackie will be there. We'll all be there.
And then you really will have lots of people on hand to answer your questions. It's all about finance and pensions and everything else. So if you want to make some time in London and make some plans, do come along to that. It's free.
And there will be drink. And food.
And there will be drink.
Yeah, yes. In fact, we paid for it already, so I hope lots of you come. It should be fun. So the next webinar is August. I think it's August the 16th. But the details. I think it's the 20th. Actually, okay, and it's all the details are there on Eventbrite. So do sign up, and there's also a whole big quiz about risk, which has just gone up on the Noon website, which is also fun to start thinking about that. But I hope this has been helpful. I certainly think it has been, and it's really lovely to see so many of you. And a big thank you to Rachel and to AJ Bell, and we'll be coming back on this because I just think it's incredibly important that we all take the power that we have got to make sure that we can look after ourselves as well as we can do, and that it's not too late to do something about it. Anyway, Rachel, thank you so much. Jackie, thank you so much. Thank you to all of you. It's lovely to see so many friendly faces, and hopefully we'll see you all really soon.
Yes. Okay. Thank you.
Excellent. Bye.
Bye.
Bye.